Howdy, Jacob here. Today we're looking at DoubleVerify Holdings, Company 91 of our generic stock screener. So they are in the software industry, 3.2 billion market cap on 2.8 billion enterprise value. They provide a software platform for digital media measurement, data analytics in the US and internationally. Founded in 2008. So fairly new company, but dang, if data isn't the commodity that's pretty much most important at this moment in time, then it really is. So revenue growth we see is very substantial. It is declining though, so 75% year over year in 2019 to 26% year over year. But you still got 26% year over year growth. That's absolutely phenomenal. With gross margins 80+%, absolutely phenomenal. That means that your cost of goods sold are really jack nothing in comparison to your revenue. And then their operating margin, they're likely still reinvesting quite a bit back into themselves. And so even to have 15%, 13%, 21%, 8% is really not bad. And I think that is also diminishing the return on invested capital because that numerator portion is dampened through so much reinvestment. So let's take a quick look at that income statement. So we see that R&D has grown very much. So 24 million in 2018 to 133 million in the most recent rolling 12. And we see that is dampening their net income quite a bit. But again, research and development is one of those things where you don't know if it's going to work, but it's basically taking money away from today to possibly get even more exponential growth down the line in the future. And so if they can really get a lot of this investment to work out, then it could be a great investment, and it could be a very smart move on them. Because again, you see their R&D limits their operating profit, which limits their taxability, but can come later for much heavier growth. And we see that the free cash flow statement has capital expenditure is very low, so it really doesn't take a whole lot to run the business, especially in comparison to their free cash flow. They have a good amount of stock-based compensation, so there will be increased shares from that. And then from acquisition standpoint, that is going to actually be a majority of their use of cash. At least if we look at the last 6 years, a little bit of debt reduction, recently buying back a tiny bit of shares, but mostly a heavy amount of it is going to be their acquisitions. Their debt, they have 310 million cash on hand, 0 short-term debt, 0 long-term debt. Absolutely amazing from the balance sheet perspective. They have more cash on hand than all of their total liabilities. And so we're not concerned about this. They're producing free cash flow, they're producing earnings, and they have more cash on hand than all debt. That's going to be a safe investment from that perspective. But it can still be a not safe investment if you overpay for the valuation. And so that's what we're going to do now. Let's look at what we think this company is worth. And on the revenue growth side, I think that I might be a bit too conservative just because I always get a little hesitant with companies that have grown so much so fast. I do think that data is incredibly important, though, sticking with the future. I think 15% a year seems pretty reasonable. Maybe we're looking at low 20% for a couple of years, and then dwindles down by year 5, 6, or 7 to maybe 12%. And even at, a 10 to 12% growth rate, I think that a 25p makes sense to me. But given that, I will increase this discount rate because you have numbers. That's going to be the way you calculate it. But then you also have a story that kind of creates the numbers in the back end. And I think there's a bit more story going on here than your average company. And so for me, or at least the companies I view are a bit more mature. They're pretty close to their. It's a lot easier to make assumptions because you can see what they've done in the past, and it's going to be very much like that. Whereas here, we don't have a whole lot of history, and the history we do have is absolutely amazing for sure. But can they keep it up? We just don't have the long plethora of resume to really back that up. So I'm increasing my discount rate a tad. As for margins, I think I would be fairly comfortable with. Here, if we're creating a story, 15 and 20%, And again, this is because they're investing so much into themselves right now. We saw through the R&D, like that 130 million of R&D spend compared to that 591 is, I mean, 20%. So 20% of the revenue is hit already off of the bottom line due to possible more likely growth into the future. And then that could just be, that could diminish their growth now, but that would increase their margin 20%. And so I think 15 and 20% could honestly be small at this point, but this is still assuming that they're still a smaller company. They're still reinvesting a lot into their R&D, and even still, 15 and 20% are great margins. Share change wise, I think that we got 68 million here. I mean, in relation to here, you're looking at about plus 2%. I feel pretty comfortable with that. And yeah, there's a lot of assumptions going on here. So it's one of those things where, company like this could grow 25% a year, and then this would make this company's stock price a buy right now. And so, I mean, they definitely have the power to do that. I think data is very important, but I don't want to be over optimistic when I make these assumptions. I don't want to buy every single company that's out there. I want to buy the ones that make a whole lot of sense to me, where I feel very confident that I can make a fantastic return over the next 7, 10, 20, 30, 50 years from now. And here I think you could get some compounding effects going for you, but I think that to me, it still is a tad on the expensive side. And I could be underselling their growth. Absolutely. I totally understand that. Like I said, their margins could be increased 20% by just taking away that R&D. But again, that's going to decrease that revenue growth figure. And so for me right now, I feel most comfortable with these assumptions before doing any other research. And we're saying it needs to fall 44% to get to the return we're looking for here. I do think it's a fantastic company. For me, I just want to get it at a more appropriate price, and not be too over optimistic about their future. Be fairly optimistic where you're estimating everything with all these grains of salt and such. But I do think, again, great company, want to own it, just not at this price. Thank you, and have a great rest of your day.